To understand Fidelity margin rates, it is essential to first comprehend what margin is and how it works. Margin is essentially a loan from a brokerage firm that allows an investor to purchase securities. By paying a portion of the total amount due, the remaining amount is covered by the brokerage firm and is considered a loan to the investor. Fidelity margin rates refer to the interest rates charged by Fidelity Investments on these margin loans. The rates are typically tiered based on the amount borrowed and can vary depending on market conditions. For instance, the higher the amount borrowed, the lower the margin rate. To minimize the impact of margin rates, it is crucial to maintain a solid understanding of the borrowing process and the associated costs. One key concept to grasp is the margin call, which occurs when the value of the securities in the margin account falls below a certain threshold. In such cases, the investor is required to either deposit more funds or sell some of the securities to bring the account back into compliance. Best practices for managing Fidelity margin rates include borrowing only what is necessary, as this can help keep interest costs low. Additionally, selecting securities with low volatility can reduce the risk of margin calls. It is also essential to regularly review the margin account and adjust the portfolio as needed to maintain compliance and minimize interest charges. Another practical tip is to take advantage of tiered margin rates by borrowing larger amounts, which often qualify for lower interest rates. However, this approach requires careful consideration of the associated risks and the ability to meet the higher borrowing requirements. In conclusion, understanding Fidelity margin rates and implementing effective management strategies can help investors maximize their returns while minimizing their borrowing costs. By grasping key concepts, such as margin calls and tiered interest rates, and adopting best practices, such as borrowing judiciously and maintaining a well-diversified portfolio, investors can navigate the complexities of margin borrowing with confidence.